What's up, you guys? It's Paul here from the 9 to 5 Investors Club channel. In this video, I'm going to talk to you about 4 strategies that you can potentially use to prepare your portfolio for a stock market crash, okay? So we have been seeing a lot of volatility in the stock market lately, especially last week and the week before that as well. A lot of it had to do with the rapid rise in the 10-year Treasury yields, because as you see Treasury and bond yields going up a lot, you'll see that those are really safe assets where people can start transitioning to put their money in. Okay, so previously we saw that the 10-year Treasury yield was less than 1%, down as low as a 0.5% towards late 2020. And when the Treasury yield is so less, no one would want to put their money in there because that's below inflation, and people would pretty much be just wasting their money putting cash in there for a yield. Okay, but recently it started rising rapidly and shot up over 1.5%, which actually shows you that that's a pretty decent yield to get on your money, considering its treasuries are backed by the U.S. government. There's a guarantee associated with it, unlike stocks or fund ETFs or any of that. And so as yields started going up, people might want to sell out of riskier assets like individual stocks or funds and start putting a little more money into the treasuries. Okay, that's the main reason we have been seeing a bit of rotation from riskier assets into treasuries, leading to the huge pullback that we have been seeing over the last week. Okay, now when or if a real stock market crash is going to happen, no one's going to be able to predict that, but I think it's becoming more and more possible that it can happen, and so you should be able to prepare yourself and your portfolio in a way that you're benefiting or at least protecting yourself from a huge downside in case this does happen. Okay, now, so the first strategy obviously that anyone is going to tell you is start building more cash. Okay, so it can be anywhere from 15 to 30%. If you want to be more aggressive, it can be as low as 10%, but ideally you slowly want to scale it up to 15, 20, 25, or even 30% as we keep pushing all-time highs in the market. Okay, so when I say 15 to 30%, I don't necessarily mean that it should be within your brokerage. I actually mean that it could even be in your checking or savings account, or just in the money market balance, or wherever you hold cash, for example. It doesn't necessarily mean you should sell out of 15 to 30% of your portfolio and hold it in cash. You can hold your portfolio, but stop buying too much. Start saving up more from your income or your paycheck or whatever. Start building more into a savings account, so that if we do have a crash, you're ready to put in a good chunk of that cash into the market to buy the dip. Okay, now on top of building that cash, first thing that I would recommend is for you to minimize margin as much as possible. I myself do use margin, but especially with the huge crash that we did see last year, it was a great opportunity to buy the dip, and I did end up using a pretty good amount of margin, and I started taking my profits along the way to pay off the margin. And especially considering a lot of brokerages, especially Robinhood, which I use, only has a 2.5% interest rate. That's a really, really low interest to be able to take advantage of the huge dips in the market that we saw during the market crash, as well as the 2 corrections that we saw in September and October of last year. Okay, so those are the only times that I do use margin to take advantage of the dip. But once we start hitting all-time highs, that's the time to start paying off your margin or taking profits to pay off the margin and getting it as close to zero as possible, and actually getting to a larger cash position. Okay. Now, the second strategy I use, and I have been using with my members in Discord, is to start hedging a portfolio with long-dated puts or calls on UVXY or SQQQ. Okay, so to show you an example here, I'll pull up my portfolio. So UVXY is basically the volatility index. In case you didn't know about it, it provides you 1.5x leveraged exposure to an index comprising of the first and second month VIX futures positions with a weighted average maturity of 1 month. A simple way of putting that is basically it's tracking the volatility index, and if you're seeing a market pullback like we saw earlier last week, as well as on Thursday, VIX started shooting up. Okay, so on Feb 25th, which was Thursday, we saw that the market was pulling back quite a bit, and VIX shot up from 847 all the way to 1041, which is a huge spike. Okay, that was like a 20% plus move. So that's exactly what will happen if you have some long dated calls on UVXY, for example, where on a huge dip like this you can take advantage of it. And that's exactly what we did. We picked up a couple of June $11 calls earlier in January, expecting that we would see a correction anytime in the next couple of months. And that was a great time to actually start selling out of some of these calls. So I sold two at 345, two at 390 on the 25th as it was spiking here, and that was a great opportunity to actually reinvest those profits to buy the dip. Okay, so that's a great way for you to hedge your portfolio. I wouldn't go too heavy into this. I would say make it 2% of your portfolio as a starting position, and if we really are pushing all-time highs, maybe start scaling it to 4, 5, 7%, so that you're a little more heavily loaded in hedging your portfolio, so that if we do see a big crash, then that 5 or 7% that you use as a hedge can actually protect you on the downside, and not just protect you on the downside, but actually let you use those profits to buy the dip. Okay, now on top of UVXY, I also had a couple of SPY puts here. Obviously, last week when we saw this huge little pullback on the same day, I started selling out some of the puts as well. I had 5 of these puts. I sold one at 315, a few more in the low 300s, and a few at the 290s or so. So this was where these hedges really started can really start protecting you. Some SPY puts. Again, as you can see, these were also May 2021 $300 puts. They are far out of the money, so I didn't put in too much cash, as well as giving it a lot of time, like 3 or 4 months, because I got this in January as well. Okay, so these kind of hedges can really protect you on the downside, and not just that, but let you take profits to reinvest back into buying dips. Okay, now the third strategy that you can use, and this is what Kathy Wood is actually doing, is to actually rebalance your portfolio and actually arrange your asset allocation in such a way that you're not invested in very high growth aggressive stocks. Okay, so Kathy Wood came out on CNBC recently talking about deep value stocks, where the host Scott was actually asking her that with the rise of interest rates, don't you think all the stocks that you're invested in can get hurt pretty bad because they're high growth stocks? And she agreed that of course that her portfolio would be the prime candidate, or the set of stocks she's invested in would be prime candidates to get hit badly with interest rates. But what she's actually doing is she's slowly starting to take profits on higher growth stocks that she's up a lot on, and starting to reinvest in like what she calls deep value stocks. Okay, so some examples that she gave were Regeneron or Takeda as examples. I can think of Disney, for example, J&J, Caterpillar, some banks, for example. These are like value stocks that that don't necessarily drop that much in case we do see a market crash. Okay, and her strategy is she knows that she's going to see a pullback or take losses on those stocks, but she knows that they won't drop as much as her higher growth stocks like Tesla, Palantir, Square, or any of them. So she's planned to use tax loss harvesting by taking some losses on those deep value stocks and then reinvesting that in the higher growth, her highest conviction stocks. Okay, so that's what I always tell my members too, is like anytime you're seeing a huge pullback in the market, the best thing to do is, first of all, I recommend holding your shares, because buying the dip is the best way to actually trade during volatility, just to add to your position, especially in your highest conviction positions. But if you have any speculative positions that you don't necessarily believe in for the long term, and you do desperately need cash, then trimming out of your most speculative positions, or positions that are not doing well, that you don't actually plan to hold for the long term, those are the ones that you should trim out, cut your losses, and use that to actually buy the dip on your strongest conviction buys. Okay, and that's exactly how Kathy Wood also has been trading recently. Now, the fourth strategy that you can use is to focus on recovering your initial investment to build capital. Okay, so whenever I talk about recovering initial investment, I typically talk about positions where you're potentially up more than 100%, because when you're up over 100%, you essentially 2x your money, and if you sell only half your position, you will recover your full initial investment, and then you're not only building up cash, but you're also removing any downside risk, because you already recovered all the money you put in. Okay, I'll show you some examples here. So for ARKK, I posted this June 18th 152.96 calls. Earlier in January or so, we picked up 2 calls at 7:05, and obviously over the last month or so, we did see a huge spike in ARKK, and it started shooting up quite a bit. And once it shot up a little over 100%, I sold one of the 2 calls at 1600. Okay, so average cost of 705 for 2 of them, that cost 1410. And by selling just one after it shot up over 120, 130%, we sold one, and we were fully able to recover our initial investment and lock in about a $200 profit. Okay, so now we are pretty much playing with house money, and obviously our came back down quite a bit over the last 2 weeks, so it's very close to where we bought them, up only 11%. Now obviously part of you might be thinking, wait a minute, why not just sell both of them and lock in a good $1,800 profit? That's possible too, but considering this doesn't expire until June 18th, I feel like this still, once ARK does start recovering, which I think it will over the next 4 months, I think it can go back up again and potentially more than 1,600, which is why I'm still holding on to at least one. Okay, so but this is a classic example where you can sell half your position and fully recover your investment and pretty much play with house money. Okay. Now Disney is another example. This was another call that I posted too, where we got the June 18th 210 calls, and we actually got 3 of them at 375 that you'll see in the history here back on Jan 25th. And Disney obviously started shooting up quite a bit, especially leading to earnings after we found out that they got their 95 million subscribers with Disney Plus and everything. So they ran up a lot leading to earnings, which was the great time to actually sell some of your position, especially because you will have an IV crush after earnings. Okay, so we sold off one on the 22nd around 900. This is actually after earnings. I should have sold before earnings, but still 900 is still almost a 3x from where we bought it. So we sold one at 900, and then the market was still pulling back, and I sold one more at 830. So if you look at the net investment, it's 1125, and we sold just 2 out of the 3 for about 1730, which is over a $600 profit. And I'm still holding one more because I think Disney can recover again. Okay, so this is a strategy that you can use where you're recovering your initial investment as well as locking in some profits. Obviously, if I sold all of them at 900, it would have been a solid $2,700 return or a $1,600 profit. That would have been great too. But thing is, when you have calls that expire so far out, and you are bullish on the stock, I do think Disney can be 200 or 210 plus by June. So that's why I still want some exposure to it, but I'm minimizing my risk by taking some profits and recovering full initial investment. Okay, so those are the 4 strategies that I wanted to share with you guys. Build up some cash if market keeps getting back to all-time highs, and get out of margin. That's for the first strategy. Your second strategy is start having some long-dated puts, for example. So puts on SPY or calls on volatility indexes like UVXY or SQQ. Be careful with calls on UVXY because there is no real bottom with UVXY. It can keep decaying, and every time it reaches a certain value, the fund actually does a reverse split, which brings up the value, but there is no real bottom for UVXY. So be careful with UVXY. That's why I use a combination of like SPY puts and some calls on UVXY, or even SQQQ, which is basically like the inverse, the NASDAQ, so calls on either of them and SPY puts are good hedges for your portfolio. Third strategy we talked about was rebalancing your portfolio and start moving a little bit away from high growth risky assets into safer assets, which are almost like cash or deep value stocks like Kathy Wood was talking about. And the fourth is recovering your initial investment to build up capital on positions that you're up at least 100% or more on. Okay, if it's not speaking of recovering initial investment, I only do this on options, by the way, because with shares, like I said, I prefer holding them for the long term, because I think if you have a 3 or 5 or 10 year outlook on that particular company, it may go up 3, 4, 500%, and you would just be missing out on that upside by selling out at just 100%. Okay, so to give you another example there, I want to show you Magnet. Magnet is a company that I've been very bullish on. I've been in it for 2 years. I got this pretty much as a penny stock, and as you can see, this stock is up over 2,200%. Okay, on 500 shares. So if I sold out 250 of them as soon as it shot up 100%, I would have missed out on a huge upside over the last 2 years. Okay, that's exactly why I try to hold my shares. The examples I gave you were on the call options on ARKK and Disney, because I'd rather hold my shares and run through the ups and downs. It doesn't really matter, because Magnet went from around $63 sometime at the highs down to like 49. So that's a $14 move on a 500 shares. That's like a $7,000 downside if you see from the highs, but that doesn't really matter to me because I always try to buy the dip, so I want to hold the shares for the long term. If I think Magnet is going to be $100 or $200 over the next 5 years, there's no reason for me to take profits right here. So that's why I rather hold the shares and only do the recovering the initial investment on options, because options can expire worthless, but shares will dip and likely recover as long as it's a good company. Okay, so that's what I want to share with you guys here today. If you found this helpful, if you found this valuable, please just smash that like button, leave a comment below to share your thoughts with me, and be sure to subscribe and hit that notification bell if you haven't already. Okay, thanks again for watching, and until next time.